Hello everyone, this is Professor Slaughter again, and the purpose of this video is to kind of go over this accounting review that we had to do in class to get ready for the Finance 215 course. Now, I will talk to a couple of accounting professors to find out when they covered some of this information. So as we move from problem to problem, I'll tell you when you would have studied this information. As you know, Accounting 212 is a prerequisite for this course. Okay, so alright, so let's first of all look at the first McGraw-Hill problem, which basically you would have covered in Accounting 211. So you can see, based on the data that's given, that this is going to be a balance sheet. This is going to be a balance sheet problem, and we know that on the balance sheet we have things like current assets, current liabilities, but we're just going to be looking at the asset part of the balance sheet. So let me write up here, balance sheet. Okay. And then we're going to look at, you know, we already know pretty much what's given in this problem. We know that we have total assets of 18. We have total assets of 18 million. So since we're dealing with the entire part of the asset side of the balance sheet, let me make this a little bit more clear. We're going to go all the way down to the bottom of this page, and we're going to make the entry that total assets equals $18 million. Okay? The next information that we have, we know that says Brenda's Bar and Grill has total assets of 18 million, of which 12 million are current assets. So we'll go back up here to the top, and we will insert a line for current assets, and we know that those equal 12 million. We know that cash makes up 10% of the current assets. So basically, since we know that current assets are 12 million, then we now know that 10% of 12 million is our cash balance, and that gives us 1.2 million. The problem also tells us that accounts receivable makes up another 40% of current assets. So when we take the 12 million and multiply that by 4%, we get 4.8 million. And it asks us, what is the balance of the inventory and the balance of depreciation? So we know that we're going to be solving for, at some point, this inventory number is what we're going to need. Okay? Okay, then it goes on to say that the gross plant and equipment has a book value of 16 million. Okay, so if we come down here and we just put gross plant and equipment and put 16 million there, and then we have other long-term assets have a book value of 500 or 500,000. Which is $500,000. Okay? Okay, so we've kind of set this up perfectly so that we can go back and solve these problems. Now we know that we're going to be calculating inventory, and we're also going to be calculating depreciation. And then once we have those two pieces of information, then we can add in our net plant and equipment. Okay, so let's take this step by step. We've already calculated up our cash and marketable securities We have done our accounts receivable. Since we know our current assets total $12 million, then we know that our inventory has to complete that top part. So when we take 12 million and we subtract 1.2 million and subtract 4.8 million, that gives us $6 million in inventory. So that's part of our answer right there. Then it asks us to calculate our depreciation. Okay, so when we're looking at that figure, since we know total assets equal 18 million, then we know that our net plant and equipment is going to be 18 million minus these assets, other long-term assets, and then our current assets. So we're going to take 18 million, we're going to subtract $500,000, and we're going to subtract 12 million. That's going to give us a total net plant and equipment of 5.5 million. And then, of course, once we know the net plant and equipment and we have the gross plant and equipment, we can subtract those two, which will give us our depreciation amount of 10.5 million. So this is kind of a puzzle piece, working through a puzzle. And this would have been covered in Accounting 211. All right, so now let's look at problem number 2. And I've been told that this would have been covered somewhat in Accounting 212. Accounting 212. Okay, so when we are doing problem number 2, what we're basically doing is we're working with two values. We're working with book value, which is the value that's being carried on the financial records, and then the market value, which has to do with what they will actually get if they were to conduct any activities on the open market, what the values would be. Okay, so it says that Muffins Masonry Inc. balance sheet lists fixed assets as 24 million. So we can go ahead, and we know that since it's on the balance sheet, it is the book value. So we'll put book value at 24 million. It says these fixed assets can currently be sold for 39 million. So now we know that the market value of these fixed assets are 39 million. Muffin's current balance sheet shows current liabilities of, and what I'm going to do here is I'm just going to make some notes down here at the bottom so we don't lose track of this information. Okay, we know that there is current liability of 10.50 million, 10 million, and they have net working capital of 9.5 million. And it says if all the current accounts were liquidated today, the company would receive cash of 7.75 million after paying $10 million in liabilities. Okay, now I'm going to add that right here, and let me tell you why. This is almost like selling a home, okay, in that you know that you have to pay the debt off, and that current liability amount is 10.50, and then you're going to have 7.75 left over to put in your pocket. So if we take that 10.50 and we add it to the 7.75 million, we get 18.25 million, which is basically a liquidated cash value. Okay, now in order to solve this problem and in order to get the total values here, we're also going to have to know where we're at with the current assets, okay? And we just solved one of the problems here because we know that the market value, if we sell off our assets, the current assets, we're going to have 18.25 million. Okay, that's what the cash is going to be. That's the cash that we will collect. Okay. But let's look at it as a manipulation of net working capital. And if we go back and we look at the net working capital equation, the net working capital equation is equal to current assets minus current liabilities. Okay? So if we want to figure out what the current assets are here by manipulating this formula, we would have to kind of switch it around a little bit. So we're going to have net working capital. If we're going to solve it for current assets, we would add the current liabilities to both sides, which would give us current assets. So we know that our net working capital is 9.50, and we know that our current liability is 10.50, and then when we add those two together, we end up with 20 million, which gives us a total book value of 44 million. Now, when we add over here to the market value, we're going to take 18.25 million plus the 39 million, and that's going to give us 57.25 million. And those are your answers. Okay. And I just had the computer skip a little bit, so I'm hoping that that did not mess us up too bad. Now, you would have had some of these calculations in Accounting 212. Okay, so now we're going to move on to problem number 3, which you would have covered in 212. Okay, so it says you're considering a stock investment in one of two firms, no equity and no debt, both of which operate in the same industry and have identical operating income of 20.5 million. No equity finances its 70 million in assets with 69 million in debt, on which it pays 10% interest, and $1 million in equity. No debt finances its $70 million in assets with no debt and $70 million in equity. Both firms pay a tax rate of 30% on their taxable income. Okay, so we're going to look at how this is basically calculated. Anytime I have a problem, the first thing I do is decide what am I solving for and how is that calculated. And in both cases, we're looking for the return on assets and the net income. Okay, so this is part of the net income equation. So if we just set it up as a partial income statement, okay, we've got no equity here, and then we have no debt here. All right, so we know that both sides have an operating income of 20.5 million. And we also know, and we're taking a look at this from a tax standpoint, okay? So if we brought in 20.5 million in operating income, we're not going to pay tax on that whole amount. We're going to be able to write something off. And what we're going to be able to write off is the interest that we have to pay on the debt, okay? So in the case of no equity, they financed their assets. Let's see what it says in the problem. No equity financed its $70 million in asset with $69 million in debt, on which it pays 10%. So if we look at 6.9 million, and we're going to finance that with 10% interest, then what we're going to end up with is an interest payment every year of 6.9 million, and that is going to lower our taxable income to 13.6 million. Okay, Now, we also know that because no debt doesn't have an interest payment, that their taxable income is $20.5 million. Okay, so we'll put taxable income right here. Okay, so both firms have a tax rate of 30%. Okay, and if we take the 13.6 million and we multiply it by 30%, we end up with a tax payment of 4.08 million under no equity, and no debt. Has a tax payment of 6.15 million. And you know, this is one of the things that I really don't like about how our country operates. You end up paying more taxes if you don't have any debt. I mean, even in a company, if you don't carry any debt and you have no interest to write off, you end up paying an awful lot of taxes to the government. So it rewards companies that have a high amount of debt, and it punishes companies that don't carry a whole lot of debt. So then when we look at figuring out what the net income is, it becomes very clear that what we have to do is subtract these two. So we have 13.6 minus 4.08, and we end up with 9.52 million. And over here we subtract 6.15 million from 20.5 million. We end up with 14.35 million. And in both cases, we had to calculate the net income, so we've done that here. Now we've got to we have to calculate the return on assets. And so the return on asset equation is calculated by taking the net income and dividing it by the assets. So we know each company has 70 million. So if we take 9.52 and we divide it by 70 million, we get a return on assets of 0.136, which is 13.6%. If we do the same thing with a 14.35 million divided by 70 million, we end up with 0.205, which is about 20.5% return on assets. And so we're looking for this answer here and this answer here for problem number 3. Okay, so I'm moving through these pretty quickly, so if you have any questions, I expect you to stop the tape and listen to the example a couple of times, and if you're still not getting it, follow up with your accounting professor, or you can definitely get in touch with me and I'll work with you the best way I can as well. Okay, so now we're looking at question number 4, which you would have covered in Accounting 211. And basically it's giving you a whole bunch of information, and it's asking you to calculate what the depreciation expense is. Now what I'm getting ready to do here, this is just again another takeoff on the net income equation. So we know that the net income equation, and once I write this down it will look very familiar to you. You've got your net sales less your cost of goods sold, right? And that is going to give you your gross profit or your gross profit margin, however you calculate it. Alright, then you're going to take out your depreciation expense, and then you're going to take out your operating expenses. And that's going to leave you with EBIT, which is earnings before interest and taxes. So now that interest is next, now we're going to take off the interest expense. And that's going to leave you with earnings before taxes. Then we're going to take away the taxes, and that is going to leave you with your corporate net income. Then you're going to take out your dividends. And this is going to tell you what the addition is going to be to retained earnings. Okay, so once we take the time to write down the formula, then we know exactly what we're getting ready to do here. So what information does this problem provide? First of all, it says net sales $12,500,000. Cost of goods sold $9 million. So if we stop right there, we know we've got our gross profit of $3,500,000. Okay. It wants us to calculate depreciation expense, so we'll leave a box there since we don't have it. We know that we have operating expenses of $260,000. Okay. Then what's next? Addition to retained earnings. So we can come down all the way to the bottom of this equation down here, and we can list this $1,090,000. And then we know that we've had dividends paid to stockholders of $380,000, which is going to leave us with our net income. Okay, we know our interest expense was $950,000, and we know that our tax rate is 30%. So when you look at this, we have everything that we need to get started, but the problem is actually asking us to calculate what this depreciation expense is. So anytime I'm doing something like this, I try to knock out the stuff that's the easiest part of it first. Okay, well, first of all, we've got everything that we need right here to calculate net income. So if we take $1,090,000 and we add back to it $380,000, we get $1,470,000. Okay. Now we can calculate the $1 million, the taxes, because we can see what is left behind after paying taxes. All right, hold on just a second. Now, if we're paying 30% in taxes, we know that we did not pay on 70%. And when we do that calculation, it's going to give us our earnings before taxes of $2,100,000. And so the way I got that was I took $1,470,000 and I divided it by 0.7, because that's how much money we didn't pay taxes on, which gave me the $2,100,000. Then when I go back and I multiply that by 30%, which is our tax liability, that tells me that the taxes were $630,000. So with this $2,100,000, I can now add back in the $950,000, which is going to take me right here to the earnings before interest and taxes, which is $3,050,000. Okay. And then we've got a situation here where we know the earnings before interest and taxes were $3,050,000, and we know our gross profit is $3,500,000. So let's take our gross profit, $3,500,000. We're going to subtract $3,050,000, which is going to give us $450,000, which is the value of these two things. And we know that we've already put $260,000 of that toward operating expenses, which is going to leave us $190,000 for depreciation expense. So ultimately, this is the answer that they are looking for problem number 4. Okay, now problem number 5, you needed a little bit of background in that you had to take a tax course, and for a lot of you that wasn't required. So the tax rule that you may have been missing for this question was the whole situation on how do you know that dividends are only 30%. That's part of the tax law, okay? So the information that's given in this problem, we have 2012 taxable income, which totals $28,500. I'm sorry, $28,500,000. We know that we've got interest charges, which is going to reduce our liability by $8,100,000. We also know that we received dividends from a company, and basically what that means is one company owns stock in another company, and we're going to pay 30% on those dividends, okay? So we know that as a function of tax law. So $710,000, okay, and then I'm just making a note here that we've got to deal with that 30%. We also paid out dividends of $5,050,000, okay, and we're going to be solving for the income tax. Again, if you didn't have tax class, this may have been a little bit more challenging for you. Okay, so we have our taxable income, and what we're going to figure out right now, we're going to figure out our tax liability based on that taxable income. Okay, so we've got a taxable income, $28,500,000. We know that we're not going to pay taxes on the interest. We do know let me make sure I'm calculating this right. Got one little calculation I have got to do here before I check it out. Okay, we know we are going to have to pay taxes on 30% of this $710,000, which is $213,000. And then when we add all of that together, $28,500, $8,100,000, and $213,000. Oh, I'm so sorry. We're going to subtract. We're going to take $28,500,000, and we're going to subtract $8,100,000. I think I added it in, and then we're going to add in $213,000. We get a taxable income of $20,613,000. We know that our tax rate in this problem is 35%, okay? So we're going to multiply it by the 35%. And we end up with a tax liability of $214,550. So this is our tax liability that we're going to have to pay to the IRS. Now, we can confirm the average tax rate. You calculate your tax rate by saying the tax liability divided by the taxable income, which is $20,613,000. And when you do that calculation, 7,214,550 divided by 20,613, you get 0.35%. This is your average tax liability. And it falls right in line with the 35% in the tax tables. All right, again, you would have not had this in Accounting 211 or 212. This would have been based upon your tax accounting class, which you may or may not have had. Okay, so moving right along to number 6. In number 6, what we're looking for is solving the problem of what the cash and marketable securities are. Okay, so when we look at that, it says calculate the value of cash and marketable securities, and then it gives us some information. So let's write down the information that we have. We have current liabilities of $8,600,000, and then we have a current ratio of 2.0. This is our current ratio. All right, then we have an inventory turnover of 12. Then we have an average collection period of 30 days. And then we have another piece of information, credit sales of $64,006. Okay, so before we start messing around with these ratios and trying to use them in the context of solving a problem, let's write down exactly what they are. So with the current ratio is current assets divided by current liabilities. Okay, we know that in this example it's a 2.0. All right, so if we know that we have current liabilities of 8.6 million, then all we have to do is solve for X to get our total assets. And I'm going to change pens here. The way we do this is the way I do it, and it seems to be the easiest way. You know, we all know 2.0 is over 1, and then X is over 8.6 million. And so what I do is multiply, cross multiply, okay, which is going to give you X equals, and then when you cross multiply, whoops, times 2, we end up with, solving for X, 17,200,000, and that gives us our current assets. Okay. All right, so then let's look at the inventory turnover. Inventory turnover. What is that equation? Well, we know in this case the inventory turnover is the credit sales. The inventory turnover is the credit sales divided by the inventory, and we know that that number is 12. So again, we're going to 12 over 1. We're going to cross, we know our credit sales. Let me put a line through here. We know our credit sales, $64,006. So when we go to cross multiply this, we end up with 12x equals $64,006. When we divide both sides by 12, we get x equals 64,000,006 divided by 12. We get $5,333,333.83. Okay, and then the last one we're dealing with is this average collection period. Now the reason why I'm doing it this way is because we're going to need all these pieces of information when we're done. So the average collection period in this example is 30 days, and the average collection period is defined by accounts receivable times 365 divided by credit sales. Okay, so we don't know what the accounts receivable is. We do know what the credit. We don't know what the accounts receivable level is, but we do know what credit sales are. So we will divide that by 64 and $64,006. Then we're going to do the same thing. We're going to cross multiply. Okay, and that is going to give us, accounts receivable times 365 is equal to 64 million times 30, which gives us 1.9 billion. Okay. And then we're going to divide both sides by 365. And that gives our accounts receivable of $5,260,274.46. Okay, so before I move any further, let's write these answers down. Okay, let me slide this over just a bit. So we have the current assets, $17,200,000. We have inventory turnover, which is going to give us, I'm sorry, we've got our inventory number of $5,333,333, and then we have our accounts receivable of $5,260,274.46. Now, if you remember, in earlier we were given current liabilities, $8,600,000, credit sales of $64,000,006. Okay, so I'm going to move this paper out of the way so we can continue to work our madness. So when we look at cash and marketable securities, what do we have here? We're going to take our current assets, cash, $17,200,000. Okay. We are going to take out our inventory because that's not part of our cash and marketable securities designation. Okay. And we're going to take out our accounts receivable because we're really, all we're looking for here is cash and marketable securities, and this $17,200 is our current asset amount. So you can see when we do the math on this, $17,200,000 minus $5,333,333.83. We take out $5,260,274.46. Hold on. Something went wrong here. $17,200,000. Let me make sure I entered it correctly. We took out $5,333,334. I'm just going to round it up. And then we took out $5,260,274. And we ended up with $6,606. I'm sorry, $6,606,392 for the value of cash and marketable securities. So that problem took a little bit of work, but you would have covered that in 212, accounting 212. Okay, moving right along to number 7. Number 7, not as painful. Again, with number 7, we are going to be solving for return on equity. And return on equity is net income divided by total equity. Let's make a note here that total equity is the difference between the total asset minus the total liabilities. Okay, so in the problem, it says that the net income is given at $190,000. So we already have part of what we need in this equation. It says that our total debt is equal to 2.46 million, and our debt ratio is equal to 60%. Now again, we can't work with the debt ratio unless we absolutely know what that debt ratio is, and that debt ratio is the ratio between debt and equity. Okay? Got some of my papers a little messed up here, so just sit tight for a second. Make sure I keep everything in the right order as we're working through this stuff. Okay, because when we're looking at debt to the debt ratio, we're basically looking at the debt. Let me get this clearer here. Total assets, not equity. Okay, all right, so moving back, get ourselves focused back on the problem. So we've got a debt ratio of 0.60, and we know that our total debt is 2.46 million. Okay, so what we need to know is what that total asset figure is, right? So that we can tell the difference in the equity, so that we know how much our total debt and our total asset total is. All right, so we've got 0.60 with a total debt of 2.46 million, and we're solving for this. So again, this is just, we put 0.60 over 1. This is a case of cross multiplying what we're doing. So we take 2.46 million and we multiply it times 0.60x, divide both sides by 0.60, and we end up with x equals 4,100,000. And that's going to give us our total asset figure. Okay, so then when we go back and we research, or we go back up to what we wrote down for our equity, if we say total assets 4,100,000, we know our total debt is 2,460,000. Then when we subtract those two, then we end up, whoops, that's not right, 4.1 minus 2.46. We end up with equity of 1.64 million. Okay, so now we can get somewhere, because now we can go back to our return on equity equation. We could say 190,000, which is the net income which was given, divided by our equity, 1,640,000. That's going to give us 0.1159 or 11.59% return on equity. That would have been covered in 212. Okay, so problem number 8, you would not have had yet. That would not have been covered in the accounting classes in 211 or 212. So we're going to skip number 8. Now, number 9 is equally, well, you know, let's go ahead and work number 8 so that you have it, because it's not real complicated, but it would not have been covered in these classes. So number 8, what do they give us? They give us the price of common stock at $38.43. They gave us our total asset value of 61 million. Then they gave us our debt ratio of 0.70. We have no preferred stock, and we have common stock outstanding, 3 million shares. And it wants to know what the market to book ratio is. Now the way that we calculate market to book, the market to book ratio, it's basically the common stock price divided by the book value. Okay, so we have the common stock price of $38.43, because that was given right here. And when we go to determine what our book value is for our stock, we're going to take the total equity and we're going to divide it by the number of outstanding shares. So the way we would do that, we would take 61 million, and we would we would take 61 million and we would subtract 42.7 million, and then we would divide that entire equation right there by the 3 million in shares. And when we get that, we get 38.43 divided by 6.1. And then when we take it a step further, 38.43 divided by 6.1, we end up with 6.3 as the market to book ratio. So you would not have covered this in 212, 211 or 212. Okay, now number 9, for those of you, it depends on which accounting program you are in as to whether or not you would have had this next problem, which is, we haven't done a whole lot with having to work backwards to calculate things, okay? That is typically done on the intermediate level and in auditing. So number 9, you would have had some of it, but not all of it. So let's look a little bit at number 9. And if nothing else, this is just a good accounting warm-up before we get started on the financial stuff. Okay, so we know that the return on equity in this company is 18%, okay, and we know that the return on equity is net income divided by total equity, or total assets minus total liabilities, okay. Now when we do our they also told us in number 9 that the debt ratio is 54%. They told us that sales were at 30 million, and the capital intensity ratio, can't spell tonight, is at 1.25 times. So if we start with the capital intensity ratio, which if we're going to solve this problem, we'll divide this right down the middle. We'll start working through this this problem here. So if we take our capital intensity ratio of 1.25, and that's defined by the total assets divided by sales, which we know to be 30 million. And when we cross multiply that out, we're going to end up with capital of intensity, we're going to end up with total assets of 37.50 million, $37.5 million. Then when we go to the debt ratio, again, I'm going to put a big star around this because we're going to need it. So we have our debt ratio. We know that our debt ratio is 0.54, and the debt ratio is total debt divided by total equity. So if we take total debt divided by total equity, okay, 0.54. All right, we're going with total debt, okay, and we're going to divide it by total equity, which we know to be $37.5 million. And when we cross multiply this and solve it out, we end up with $20.25 million. Okay. Then when we come back up here to net income, okay, we need to solve for net income. We know that our total assets are $37.5 million, and we're going to subtract our total debt of $20.25 million. And when we do this, we're going to end up with a net income that equals $3,105,000. And again, you would not have covered question 9 or question 10 unless you were taking intermediate accounting, and that may or may not be part of your academic program. But other than that, this is intended not to make you nervous about finance or anything else. It's just intended as a refresher to go over some of the things you would have been exposed to in your earlier accounting classes. So we've reviewed everything, so hopefully your brain is all turned on with the accounting information, and we'll be ready to move forward with the finance.